The live intraday price for Intel Corporation is currently trading at $95.78, reflecting the market's immediate reaction as the company finalizes its massive $20 billion equity offering today, August 12, 2026. While the headline figure of a $95 per share offering price might seem like a straightforward capital raise to the casual observer, the deeper reality is that this represents one of the most significant pivots in the company's recent history, forcing investors to weigh the short-term pain of dilution against the long-term potential of massive capital expenditure. Most market participants expected Intel to manage its cash flow through organic growth or smaller debt issuances, but the decision to go to the equity market for such a colossal sum suggests management is accelerating its foundry strategy much faster than the street had priced in. This creates a fascinating tension. Expectation was for a conservative path to recovery, but the reality is an aggressive, high-stakes bet on manufacturing dominance. Comment below how many shares of Intel stock you currently hold as we break down this shift. When you look at the general sentiment surrounding technology giants, investors often gravitate toward the consistency of Apple stock or the sheer speculative power of NVIDIA stock. Intel, by contrast, has been viewed as the reliable, steady hand, a legacy pillar of the semiconductor world. However, the current reality of the chip sector is one of high-velocity change, where legacy status is no longer a safety net. By issuing 210.5 million new shares at $95, Intel is effectively asking its current shareholder base to foot the bill for its future fabs. The dilution is real, roughly 4.2% to 4.8%, depending on how the underwriters exercise their options. And this is exactly why the stock has been hovering near the offering price. Institutional investors are busy adjusting their models, trying to determine if the $19.7 billion in net proceeds will genuinely accelerate Intel's process roadmap or simply plug holes in a widening balance sheet. If you are a self-directed investor managing your assets through platforms like Fidelity or Interactive Brokers, you have to decide if this move changes your thesis. Fidelity brokerage users and those who utilize Fidelity mobile app features for real-time tracking are likely seeing the volume spikes associated with this offering. The reality is that the chip industry is currently dominated by capital intensity. If you are using Interactive Brokers to monitor your portfolio or setting up your Fidelity IRAs, you know that the costs of building cutting-edge foundries have skyrocketed. It is not just about designing chips anymore, it's about owning the physical capacity to produce them at scale. When you contrast this with the streamlined business model seen in other segments, Intel's path looks cumbersome and expensive. However, if the company succeeds in its foundry ambitions, the current dilution might eventually be seen as a necessary cost for regaining a leadership position. For those using Robinhood stock trading or exploring options on the Robinhood app, the volatility surrounding this offering provides a classic case study in risk management. Robinhood fractional shares allow smaller investors to maintain positions even when big institutional moves cause price swings, but it requires a disciplined view of the underlying business. The same applies to users of SoFi Invest, where the platform often emphasizes active investing and understanding the fundamentals behind the ticker. SoFi stock users might find this dilution event a test of their long-term conviction. It's not enough to just look at the ticker. You have to evaluate whether the increased capital will lead to improved gross margins or if it will simply extend the timeline for profitability. The expectation was that the company would remain a leaner version of its past self, but the reality is they are choosing to double down on hardware. This decision also has implications for those using Schwab Intelligent Portfolios or other robo-advisor services. These automated systems often rebalance based on risk profiles and corporate actions, and a massive share offering changes the supply-demand dynamics of the stock. For individual investors who prefer hands-on research using Fidelity trading platform data or monitoring trends through their own brokerages, this is a moment to look at the balance sheet items that often get ignored. Why is the capital necessary now? The answer lies in the intense competitive pressure from rivals who are moving faster into specialized memory and high-performance computing architectures. Intel is essentially paying a premium to ensure it doesn't get left behind in the race for the next generation of AI-integrated silicon. The company itself operates as the backbone of modern computing. For decades, its microprocessors have been the standard in everything from personal laptops to massive enterprise data centers. Yet the business model has faced immense pressure as the market shifted toward mobile and then toward accelerated computing for artificial intelligence. Older reports once lauded Intel for its massive profit margins and unmatched manufacturing capacity, but recent years have shown how quickly those advantages can evaporate when external foundries gain ground. The reality is that Intel is now in a transition phase, moving from being just an integrated device manufacturer to being a service provider for others who need to manufacture their own designs. This requires a completely different mindset and a completely different set of operational metrics. Looking toward the future, the primary catalyst for the stock will be the execution of these capital-intensive projects. If management can demonstrate that the $20 billion is being translated into tangible manufacturing gains, the market will likely forgive the initial dilution. On the other hand, if we see further delays in fab construction or a failure to win key foundry customers, the market will view this capital raise as a squandered opportunity. The tension remains between the company's storied history and its uncertain future. Investors must ask themselves if they believe in the turnaround story or if they are simply holding a legacy asset that has lost its competitive edge. The upcoming quarterly reports will be vital. They will provide the first real glimpse into whether this cash influx is having the intended effect on capital expenditures and R&D efficiency. Institutional activity will also remain a key indicator. Watch for whether the major funds that currently hold large positions are adding to their stakes or using this event to trim their exposure. For the average investor, this is a time for patience and rigorous observation. It's easy to be swayed by the immediate price reaction, but the true value of Intel will be determined by its ability to deliver on its promise to redefine its role in the global semiconductor hierarchy. The story of Intel is not over, but it has certainly entered a more demanding chapter where every dollar spent must be justified by visible progress in technology and manufacturing capacity. The gap between expectation and reality remains the single most important factor for any serious participant in the market to watch, especially when dealing with a company that is quite literally trying to rebuild its identity from the ground up, while the entire world is watching and waiting for the results of its massive multi-billion-dollar gamble. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.